Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Microsoft Corporation quarterly report. Microsoft Corporation offers a wide range of businesses and services across various segments. In the Productivity and Business Processes segment, the company provides Microsoft 365 Commercial, Enterprise Mobility plus Security, Windows Commercial, Power BI, Exchange, SharePoint, Microsoft Teams, Security and Compliance, and Copilot. This segment also includes Dynamics products and cloud services, such as Dynamics 365. The Intelligent Cloud segment offers server products and cloud services like Azure and other cloud services, GitHub, Nuance Healthcare, virtual desktop offerings, and other cloud services. It also provides enterprise and partner services, including enterprise support and Nuance professional services, industry solutions, Microsoft Partner Network, and learning experience. In the Personal Computing segment, Microsoft provides Windows and devices such as Windows OEM licensing and devices and Surface and PC accessories. The company also offers gaming services and solutions like Xbox hardware, content and services, first and third-party content, Xbox Game Pass, subscriptions and cloud gaming, advertising, and other cloud services. Additionally, it offers search and news advertising services including Bing and Copilot, Microsoft News and Edge, and third-party affiliates. Microsoft sells its products through various channels such as OEMs, distributors and resellers, and online and retail stores. The Microsoft Corp stock price has experienced a significant increase of over 16.91% from its low in late January 2025 to its peak in October 2025. This surge can be attributed to several key news events and sustained positive trends that have driven investor confidence. One major factor contributing to the stock's growth is Microsoft's strong fiscal year 2025 earnings reports, which consistently exceeded analyst expectations. The company's robust sales of Azure cloud computing services, particularly in its Q3 FY25 and Q4 FY25 earnings reports, led to a significant increase in revenue and operating income. Additionally, Microsoft Cloud revenue reached $46.7 billion, with Azure's annual revenue surpassing $75 billion. The accelerated growth in cloud computing, Azure, and artificial intelligence, AI, has also played a crucial role in driving the stock price up. Microsoft's emphasis on its leadership and investments in these technologies has fueled investor confidence, as evident from CEO Satya Nadella's statements highlighting cloud and AI as the essential inputs for every business. The successful integration of AI capabilities across various products has been a significant positive factor. Furthermore, Microsoft's strategic partnership with OpenAI and AI integration into its Copilot product lineup has been a key differentiator. This alliance has provided investors with compelling reasons to consider Microsoft stock, particularly given the company's focus on integrating generative AI features across its Office products and other business software. While the most recent FY26 Q2 earnings report showcased strong results driven by cloud and AI, concerns regarding slowing cloud growth and high AI infrastructure spending led to a subsequent dip in the stock price. Nonetheless, the sustained strong performance in these segments and optimistic market outlooks have contributed to the stock's overall increase of 9.68% from January 29, 2025 to January 28, 2026. Microsoft Corporation market capitalization of $3,580 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Microsoft Corporation holds a significant advantage in their industry. Microsoft Corporation trades at a higher price-to-earnings ratio of 30 times and a higher price-to-book ratio of 10.42 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The company maintains a moderate leverage profile, with liabilities making up 45% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline for a company can be attributed to various factors. On the growth side, cloud computing has been a significant contributor, with Azure and Dynamics 365 experiencing strong demand, leading to a 29% year-over-year increase in revenue. Additionally, productivity segment revenue grew by 12%, driven by Office commercial products and LinkedIn. Microsoft 365 commercial cloud revenue also saw growth, as did other cloud services such as Azure. LinkedIn and Dynamics 365 were other notable contributors to revenue growth. Furthermore, search and news advertising revenue, as well as Windows OEM and devices revenue, experienced growth. On the decline side, Xbox hardware and content/services revenue declined, along with gaming revenue. More personal computing revenue also saw a decline, attributed to decreased hardware sales. These factors highlight the importance of diversifying revenue streams and adapting to changing market trends to ensure sustained growth. The net income of the company experienced a significant increase in both Q3 2025 and H1 2025 compared to the same periods in 2024. In Q3 2025, it rose by 60% to $38,458 million from $24,108 million in Q3 2024. While in H1 2025, it increased by 36% to $66,205 million from $48,775 million in H1 2024. This upward trend is also reflected in the profit margins. The gross margin and operating income margin both saw improvements in Q3 2025 compared to Q3 2024. The gross margin rose to 55.295% from 47.833%, while the operating income margin increased to 47% from 45.6%. These changes suggest that the company has been able to optimize its operations and improve efficiency, leading to higher profit margins. The reasons behind these positive changes are multifaceted and include net gains from investments in OpenAI, growth in Microsoft 365 commercial cloud, a shift towards higher margin businesses, and decreased operating costs. However, there are also potential risks that could impact the company's future performance, such as increased operating costs, uncertainty around leveraging acquired companies' capabilities, and disruptions in global markets and economies. The company's financial performance is a testament to its ability to generate positive operating cash flow. For the 3-month period, net cash from operations stood at a substantial $35,758 million. This figure more than doubled in the 6-month period, reaching an impressive $80,815 million. Furthermore, cash from operations increased by a significant $24.3 billion over the same period. These numbers demonstrate the company's capacity to generate strong operating cash flow, indicating a healthy financial position and a solid foundation for future growth. The company's financial performance varied across different segments and regions. In terms of segmental performance, Intelligent Cloud was the standout performer, achieving a significant increase in revenue and operating income of 29% and 27% respectively in Q3. This growth was followed by productivity and business processes, which also showed improvement, albeit not as pronounced as Intelligent Cloud. On the other hand, more personal computing segments struggled, with declines in both revenue and operating income. Geographically, the United States and other countries performed similarly, with a 17% increase in revenue for both regions in Q3. This suggests that while there were regional differences, they were not significant enough to impact overall performance. Management is optimistic about the company's outlook, citing a long-term strategic partnership with OpenAI to advance artificial intelligence responsibly. To drive growth, the company is investing heavily in AI infrastructure and talent, which has led to a decrease in gross margin percentage despite efficiency gains and sales mix shifts. The management team is prioritizing investments in cloud-based and AI services, including compute capacity and AI talent, as well as continued investments in Azure and Microsoft 365 Commercial Cloud. This focus on emerging technologies is expected to drive revenue growth, which was 17% for the current year compared to the prior year. However, management also acknowledges several challenges facing the company. These include significant cybersecurity risks due to evolving threats, data protection regulations restricting data flows across borders, and global market downturns and economic risks that may affect the investment portfolio. Despite these challenges, management remains committed to investing in research and development to establish technological feasibility for software products. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out significant amounts over the past year. For the 3 months ending December 31, 2025, the company paid $6,762 million in dividends, while for the 6 months ending on the same date, the payout was $12,931 million. The company also engaged in share buybacks, repurchasing a total of 35 million shares over the past year. Specifically, in the 6 months ended December 31, 2025, the company bought back 20 million shares. This demonstrates the company's commitment to returning value to its shareholders through both dividend payments and strategic share purchases. Concerns about inventory buildup or supply chain disruption are valid and multifaceted. One of the primary concerns is the potential for extended disruptions at suppliers with few qualified alternatives. This can be exacerbated by dependence on third-party contract manufacturers and global economic developments that may lead to changes in trade policies. Inventory buildup is also a concern, as it can result from excess or obsolete inventory, component shortages, and price reductions leading to inventory adjustments. Furthermore, supply chain disruption can occur due to limited suppliers for certain device and data center components. Disruptions in the supply chain, particularly in Asia and other geographies, potential supplier capacity constraints, industry shortages, or regulatory changes that restrict supply sources. Supply chain regulations may impact the availability of goods, with U.S. import controls restricting the integration of certain information and communication technologies into the supply chain. Restrictions on data flows and outbound investment may limit the ability to leverage parts of the global engineering footprint, while volatility in U.S. tariffs has triggered economic uncertainty that could impact cloud and devices' supply chain cost competitiveness. Additionally, supply chain disruption can be caused by various factors such as bankruptcy of major distributors/OEMs/retailers, geopolitical conditions, e.g., conflict in Ukraine, disruptions caused by natural disasters, cyberattacks, and other catastrophic events that could disrupt operations, and pandemics affecting global supply chains and economies. That concludes the financial summary for Microsoft Corporation. Feel free to comment below, and I will be happy to answer them when possible.